Welcome, everyone, to How to Pay Less Taxes. I'm Heather Dunn, the Digital Marketing Manager here at ATBS, and I would like to thank you for joining us today. Before we get started, I want you to know that you can type in a question to the box on the right of your screen at any time. We will answer all of the questions at the end of the webinar. Also, this webinar is being recorded, so if you have to jump off or if you lose connectivity, you can go to atbsshow.com or teamrunsmart.com to watch the webinar again. There will be a few poll questions during the webinar, so please participate in those, and they will appear on your screen throughout the webinar. Now, I'd like to introduce you to our presenter today. His name is Todd Amon. He is the CEO and president of ATBS. So thank you so much, Todd, for being here, and I'll let you take it away.
Thanks, Heather. I appreciate the introduction, and thanks to everybody attending the webinar today. I'll get started by saying just a couple of things. And if you're like me, the main topic of conversation for most people the last few months has been the weather. And if you're like me, you're kind of sick of hearing about the weather, and we just are ready for the sun to come out and let us, keep driving and stop fighting the ice and the snow and all those kinds of things. If you're probably not like me and you don't live in Colorado, the other main topic of conversation the last couple of months has been legalized marijuana, and I'm kind of sick of hearing everybody ask me about that topic too. So I'm really excited to talk about taxes, whether you are or not. It's something that we're passionate about here at ATBS, and so I really look forward to sharing some things with you today. There's really two certainties in life. Most of you have probably heard that quote before, and they're death and taxes. And one thing I heard not too long ago that I thought was really interesting, took me a minute to think about it, was a quote that said, on the long enough horizon timeline, the survival rate for everyone becomes zero. And so that goes to the death piece. Something you've heard about, maybe taxes. If you live in America and you make money, you will pay taxes. And so most of the folks on the call are probably independent contractors. And I hear all the time folks that say they became independent contractors. They have a friend that's an independent contractor, and the reason they do it is so they don't have to pay taxes. And to be honest, that's just a pure fallacy. So really, my goal is to help you gain a better understanding of taxes and kind of take some of the mystery out of it, and really help you understand the tax code. It's kind of what we do here at ATBS is help customers, save money, pay less taxes, and do better in their business. So that's what we're going to spend our time doing today. Um, One other quote I would kind of want to give you is we like to have a little bit of fun. We're kind of working 24/7 here at ATBS right now during tax season. We cram about 12 months worth of work into 2 months to get all the tax returns done that we do. In fact, as of yesterday, we've done about 2,000 tax returns already. And our marketing team has got some great humor that kind of keeps things light around here when we all get stressed out because we're working too much. And so they have the top tax jokes on our website, and we'll refer to the website a few times today, and you can go there. But one of the favorite top 10 tax jokes I saw that they put on there was the guy who said the truth never hurts never had to fill out a form 1040. And it's funny, but at the same time, I like the saying because a 1040 tax return really does need to be truthful. If you cheat on your taxes, it's going to catch up with you sooner or later. So those are the things we're going to talk about. Whether you realize it or not, as of today, March 6th, we're 40 days away from April 15th, which is tax day. So for us, every day is a countdown. Truly, every hour is a countdown, but it's just around the corner. And whether you've filed your tax return or not, I hope we can give you some things to think about. What I really think about, and having been a taxpayer now for a long time and dealt with my own tax return, what I find is the more you know, you don't need to be an expert. You don't need to be a CPA. You don't need to, deal with taxes on a daily basis. What you really need to do is know the right questions to ask your tax preparer because they don't know everything about your life. And the more you understand about taxes, again, not the details, but the right things to ask, the better the tax return can be and the lot more money that you can save. So just a little more background on ATBS for those of you that don't know. We'll do about 14,000 tax returns per year. We're the largest tax preparer and server to independent contractor truckers in the United States. We have the largest tax department. So we spend a lot of time and money and effort researching the laws. In fact, we actually work with the IRS to understand the things that they're doing and the things that they're changing to make sure we're doing tax returns right for our customers and that they meet the IRS requirements. We have a tax resolution department that helps customers solve problems that haven't paid taxes in a few years, and I'll talk a little bit about that. All those things combined, I really feel like make us the experts in owner operator taxes. And so hopefully the stuff that we go through today will give you some tips and some things to help you out. So, probably the question of the day is, are you handing too much of your hard-earned dollars over to the IRS? And really the bigger question is, how would you know? And like I said, a lot of times people don't even know the right questions to ask. We might miss something on a return simply because we didn't know to ask you the question and you didn't know to bring it to our attention. So part of this is an education process, hopefully to help you really get a sense of, what's going on with your tax return. I tell you two things that I think are incredibly important when it comes to your tax return. The first thing is use somebody, whether you do it yourself and do your own research or you use someone else, use someone that understands trucking. Trucking has some very specific laws that are really, applied to you as a trucker, not just average Joe American. And if your tax preparer doesn't understand the industry, they will miss a lot of things and they'll cost you a lot of money. The second thing that I think is incredibly important that I'm going to talk about a lot is saving money on taxes is your responsibility. Even though we prepare your tax return, being organized and making sure that we have everything, we can't do that alone. We need your participation in that. So we're going to talk a lot about that. So we're going to, as Heather said, we're going to ask a couple of poll questions, and I think they'll be helpful to you as participants. And the first poll question, Heather's going to pull up right now. And it's a simple question. We just want to know, as we sit here on March 6th, how many of you have filed your tax return and how many of you have not? I think it's, interesting for you guys, and we'll give you some instant feedback just to help you know where you're at compared to the rest of the crowd. We'll just give it about 30 seconds for people to answer, and then I'll tell you what the percentages are. All right, we've got most of the folks that have voted, and so I'll just give you the quick percentages. 43% of the folks on the webinar today have filed their tax return, which means the rest, it's almost a 50-50 split, have not. So that's about I think what we would expect. We're still pretty early in the tax season. Those that have had it simple and got things done are out, but almost half of our clients these days, we will wind up doing their tax return after the tax deadline of April 15th. So as things get more complicated, as laws change, as people are, not as organized as they need to be, we do file a lot of extensions, and we'll talk about that. So thanks for being part of that poll, and it was interesting. So here's our agenda for today, the things that we're going to talk about, and let me just kind of highlight these a little bit for you. First is your tax liability. And I just really want you to, kind of understand what your taxes are made up of. Like I say, I just want to take the mystery out of taxes because so many people, just talk angrily about the fact that they've got to pay them, but they don't understand what they are and what they're made up of and why and how and all those kinds of things. Next, we're going to talk about some common and misunderstood deductions. My guess is a lot of you on the call know a lot of owner operator deductions, but hopefully we'll talk about some things that are confusing and maybe give you some ideas of some stuff that you haven't deducted before. Next, we're going to talk about tax credits. And there's a real big distinction between deductions and credits, and we'll get into that a bit more as we get into the details of those. But it's really important to understand credits are more valuable than deductions, and when we get down to that section, I'll help you understand why. Then we're going to talk a little bit about successful bookkeeping. And, it goes back to a recurring theme that you're going to hear from me. Being organized is probably your single most important thing you can do in saving money and taxes. And we'll talk about that. We're going to talk about some tax strategies, some ways that you can plan ahead and save money. And then we're going to finally wrap it up with some concluding remarks and questions. And we're going to be joined in the last half of the webinar by the gentleman that heads up our tax department here at ATBS. His name's Andy Irwin, and he just does an extraordinary job, getting the tax returns done that we do here, but also keeping up with the latest, everything that goes on with owner operator taxes. So with that, let me just get into some of the meat and help you kind of understand some of the things that we're talking about. So This is a list of the taxes that typical owner operator is subject to pay. It's by no means every tax that you pay, but it's a lot of the big ones. And so, let's just start off with income tax. And one thing I want to say about the income tax for those of you that hear, the owner operator that says I became an owner operator so I don't have to pay taxes. I just want everybody on the call to remember that our country was founded around the fact that we revolted against the British because we didn't want taxation without representation. They were levying taxes on us that we felt were unfair without us voting on them or not voting on them. So whether you feel taxes are fair or not, and trust me, I'm like everybody else on the phone, I'll pay my fair share, but I don't want to pay more than I have to. Well, understand it takes taxes to support and build our roads and our infrastructure and our military to defend us and the schools our children go to and those kinds of things. But if you're like me, you also feel the government wastes a lot of money. So I don't think we need to pay more than we need to either. So income taxes, they're fairly straightforward, even though the tax code they say is more pages than the King James Bible. It's an incredibly complex, evolved over 100 years set of codes. But at the end of the day, what happens is if I make a dollar, I'm going to get taxed on that dollar. As far as federal income taxes go, the range can be anywhere from zero to it just got raised last year, a high of 39.6%. Most of us on the call probably don't need to worry about the 39.6%. That's someone making well over $500,000 a year. Some of us are going to be somewhere, all of us are going to be somewhere in between that 0 and 39.6%. I just want to give you kind of a gauge of where your taxes add up. For an average owner operator, your income tax for the federal government probably is going to be somewhere around 20%. There's a lot of variables, whether I'm married, how many dependents I have, if I have mortgage interest, all those kinds of things. But on an average, our clients will probably pay 20% in federal income tax. Then we have state income taxes that are also really complex and really depends where I live. And so many of you know, if I live in a state like Florida, Texas, Nevada, I have zero income tax, which is great, really nice. I don't have to pay state income tax. If I live in a state like California, I might have an income tax as high as 12.3%. So again, it's really complex, depends where I live, depends on a lot of variables. But if you think about that, if I'm a rich guy making a lot of money, my federal income tax rate is going to be 40% and my California state income tax is going to be 12.3. I'm at 52% tax just on income before things even get started. So again, I just want to help you understand kind of our tax system and the way it works and where it is. When we get into employment taxes, we're going to spend quite a bit of time talking about this because this is kind of where the rubber hits the road for an independent contractor versus an employee. I just want to help you understand employment taxes for a minute and talk about what they are. So, the employment taxes essentially go to cover Social Security and Medicare. Those are the big ones. That tax rate is 15.3%. So if I make a dollar, 15.3% or $15.30 of that is going to go to taxes to cover Social Security and Medicare. Everybody on the phone probably knows Social and Security and Medicare are for retired individuals after age 63 or somewhere around there to support you in your retirement. And you start paying that the day that you work. So a little bit of a distinction here. If I'm an employee and I work for a company, those employment taxes get split between me and the company. That 15.3% gets divided up, and the company pays $7.65 for every dollar I earn, and I pay $7.65 for every dollar I earn. If I become an independent contractor, I become responsible 100% for that because I'm essentially my own employer. So I pay self employment taxes of 15.3%. So that's kind of the high level of it. And we'll get into some more detail on that and exactly how it works. You see the words FUTA and SUTA, those essentially stand for federal unemployment tax and state unemployment tax. It's not a big dollar amount, so I'm not going to go into detail, but essentially that goes to cover, a small piece of your paycheck goes to build a fund. So when we had things like we did the Great Recession 3 or 4 years ago and we had 12% unemployment rate, that's the people that collected unemployment that comes out of that tax on our paycheck that we pay every week to support those folks that aren't lucky enough to have a job. Sales and excise taxes, I think everybody probably has a decent grasp on those. If I go to the Pilot truck stop today, no matter where I am, and I spend $100 on something, it's probably going to cost me somewhere between $105 and $110. That extra $5 and $10 goes towards a sales tax, and it varies based on county, state, city. There's all kinds of different taxing districts that will add a sales tax. Um, to what happens when I buy a truck. There's a sales tax on it. One tax that every owner operator should know about, and most of them do know about, and it's considered an excise tax, is the Federal Highway Use Tax, or FHUT. That's due every July, and it's $550. If I drive a Class 8 heavy vehicle, again, it goes to maintain the roads and goes into the Highway Trust Fund. Every heavy truck in America, and there's about 2 million of them, pays $550 every July. So again, a different kind of a tax than an income tax or an employment tax, just a flat tax to own my truck. Um, we go to property taxes. So these really don't have anything to do with your business, but they're taxes you're subject to. A couple of property taxes that I can think of. I just registered my pickup. I drive a Dodge Diesel, a few years old, and I just had to pay my registration here in Colorado, and it was about $550. So about $75 of that goes towards the plate and the registration process. The remaining, $450 roughly goes towards a property tax. So, one thing I'd say is when you look at the states that don't have an income tax, Nevada, Texas, Florida, those states can't run on no money. So if you're not paying an income tax, you're probably going to make it up somewhere else. In some of those states, for my Dodge that cost me $500 in Colorado, you might have to pay $2,000 in some of those states. They have a lot higher tax on a vehicle. Property tax on your home, if you own a home, is similar. If typically the first quarter of every year, you wind up having to pay some property tax. I know in Texas, property taxes are a lot higher than they are in Colorado, again, because they don't have an income tax rate down there. Last thing I'm going to just touch on, and again, most people know this stuff, but I just want to help you understand all the different taxes out there. Fuel taxes. Diesel fuel is taxed on a federal and a state level. And the federal diesel tax is 24.3 cents per gallon. To be honest, I feel like that's too low. And you might say you're crazy when you say that. But one thing our industry is lobbying for is you guys that are out there driving on the road every day, that our bridges need repair, our roads need repair. We're sorely lacking in funding to fix our highway infrastructure system for the truckers in America. One of the solutions out there is to put tolls on the roads. And I know if you feel like I do, the last thing on earth you want a toll is because not only does it cost you money every time you go through it, but it wastes a ton of time. You might have to sit at a toll booth for a half an hour to get through. So, rather than stop commerce as an industry, we'd rather have the diesel fuel tax go up by a few cents as long as we were guaranteed that money went to our highways and to repair them and make them better and more productive for you guys. So, again, I want you to really think about as we're talking about taxes today. I know all of us would like to pay zero taxes, but think about what that means. What's going on with Russia right now, and if we wind up having to, get involved militarily, what if we didn't have a military because we didn't have taxes? Things like that. We do, in some ways, we do have to pay taxes to support what we have going on here. Fuel taxes from a state perspective, a similar concept. The fuel tax can run anywhere from 10 cents a gallon to 50 cents a gallon, depending on the state. And you'll typically find it higher in some of those states that have a lower income tax or no income tax. So, again, just kind of helping you understand those taxes, where they come from and what they're made up of. If you really added up and thought about all those things, the average owner operator probably pays of every dollar that they make, at least 30 cents, maybe 35 cents of every dollar in taxes. If you're a rich person, maybe you don't mind so much because you have a lot of money, but an average rich person in America, they might pay up to 70 or 75% of every dollar they make in taxes. So, on the flip side, when I say we need taxes to support some of the things we do in America, I think we waste a lot of money. And I'm not here to give a political editorial. You can make your own decisions, but I think you're better at making decisions when you're informed and you understand what everything goes towards. So, I'm going to talk for a minute about how these taxes get reported and paid now that you understand kind of what they are. Income taxes are relatively simple. They get paid on, they get described on forms that you get from who you work for. So if I'm an employee, I'm going to get a W-2 at the end of the year from my employee, and it's going to tell me all the taxes, and I simply plug it in a 1040 easy and get my tax return done. If I'm an independent contractor, I get a form 1099, and that only reports revenue. So that's pretty high level. We're going to go into more detail on that, but those are really the two ways the government finds out about your money from your employment perspective. We'll talk about how those get filed and those kinds of things. As far as employment taxes, um, if I'm self-employed, it gets pretty complicated. So I'm going to spend a few minutes on the next slide talking about exactly how self-employment taxes work. As I said on the previous slide, if I'm self-employed, I'm 100% responsible for that 15.3% self-employment tax. When I'm an employee and I work for a company, it's really pretty simple. If I make $1,000 last week, the company withholds all those first two items, my income tax and my employment taxes. They remit the money to the government every single week for me, and I really don't have to worry about anything. What happens is the government gets their money every single week, and at the end of the year, I usually get a refund. The reason I get a refund is because the government wants to make sure they get their money. They don't really trust us as employees to pay them the money, so they require their employers to do it for them. And so in the end, I get a refund, and it's really a pretty simple process. When I become an independent contractor and I'm self-employed, all that goes away, and I become responsible to do that all myself. So what happens is I go into a system called the estimated tax system, and I'm required myself to estimate my self-employment tax and my income tax and figure out what those amounts are, and I'm required to pay those to the government on a quarterly basis. And again, we're going to get into that in a little bit more detail on the next slide, but it's really important. That's where a lot of drivers that make that transition from employee to contractor get stuck, and it gets difficult. And after a year, if I haven't dealt with it, the bills start to mount up, and that's who we wind up getting in our tax resolution department is folks that haven't dealt with that situation. Sales and excise taxes are pretty simple. You usually pay sales taxes at the time of sale. It's collected by whoever you sold you something and remitted to the government, so you don't have to worry about that. As far as the $550 FHUT, that's paid every July on a Form 2290. It's really a pretty simple process. My guess is a lot of you have done that before, or maybe a company, finance company or truck company where you lease your truck through does it for you. Property taxes are paid on an annual basis, typically through your county or state, and fuel taxes are paid at the point of purchase. So, really, everything is pretty simple. The government doesn't want to leave things to chance, and so they've got automatic collection systems set up for everything. The only thing they don't really have automatic systems set up for is for those of us on this call that are self-employed, and that's where things get complex. And that's really why we're having this call today, is to help you understand that. So as we look at this slide, I want to make it real simple for you, even though it can, get really complicated. Our average client will pay 25 to 28% of what they make in taxes at the end of the year. And so something that you can keep in mind to make it really simple on yourself is if I make $1,000 a week, last week I got a check for $1,000, I want to take 250 of those dollars and I want to put them in a separate account, and I just want to set them aside for taxes. I don't want to touch them. And that way, they'll be there when the time comes that you need to write your quarterly estimated tax check or do your tax return on April 15th. So, let's just start there and make it simple. To talk about quarterly estimated taxes, to help you understand when they're due, the payment dates are April 15th, June 15th, September 15th, and January 15th. And the reason that the government does that is, as I said, when you're an employee, they get their money every week from your employer. When you're not an employee and you're self-employed, they have no way to get their money. So they really kind of want it to be fair, and they want you to have to pay like the other folks. And so they want you to pay every single quarter. I've heard, plenty of times from drivers that say, I don't pay my quarterly taxes. And that's certainly your option. There are penalties if you don't. They're not horrendous. They're not going to cost you, a fortune, but it's going to cost you some money. The reason I like to have our clients pay quarterly taxes is more to deal with it from a cash flow perspective. And, let me maybe deal with that a little bit on this next slide. There's really two ways that you can pay your estimated taxes. The IRS allows you to do either a safe harbor or an actual income estimate. And so let's take the safe harbor as an example. And let's say I was an employee truck driver last year and my total tax liability was $1,000. What the IRS will allow me to do this year in 2014 is divide that by 4 and pay $250 each of those quarters I mentioned: April, June, September, and January. And if I pay 250 each of those, I'll be in compliance. I won't be subject to a penalty. But let me tell you why we like the second method of actual income better. It's because your life is not the same year to year, and your income can fluctuate pretty greatly. So let's use that same example and say that I was a company truck driver last year, and my tax liability was $1,000. Let's say I became an owner operator this year, and I'm going to do a lot better. I'm going to make more money, and my tax liability goes to $4,000. So what the IRS would say is you could pay $1,000, $250 each quarter. The problem is, come next April, when I do my tax return, I'm going to owe $3,000 extra dollars. And from our experience of doing tens of thousands of drivers' tax returns, they usually don't have that money come April because the first quarter is a slow time. We spend a lot of money at Christmas, and And so I like drivers paying what they owe on a quarterly basis and really kind of matching it up because it should really match your cash flow. What we do at ATBS is take it a step further, and we actually analyze your income because we do profit and loss statements every single month. So if we're figuring your estimated taxes here in another 20 days for your April 15th estimated tax date, we're going to take your income from January, February, and March, and we're going to know exactly what it was. And if you're like a lot of drivers, the first quarter is not a great quarter, even though freight's been real good lately. It's typically slower. And so we might tell you that you owe $500 for the first quarter because that's what you made and that's what your income would be based on. When your revenue picks up and you're busier in the second quarter, come June, we might tell you that you should pay $2,500 because you made a lot more money. So what should happen is we're matching your cash flow when you should have the money to your taxes. The real true goal is at the end of the year, by the time April hits next year, we don't want you to have to write a check and we don't want you to get a check back from the IRS. We want you to be within $100 or $200 of what you truly owed. So there's no surprises. If you get a refund, all that means is you loan the government money throughout the year. And I don't know that anybody that wants to loan the government, they're not going to pay you interest on it. And if you owe money, it's usually a problem. People don't have the money to pay to the government. So the next thing we're going to talk about is something that is becoming a little bit more, I think, an issue that people need to deal with. Do you have employees in your business? And we deal with a lot of drivers that have either team drivers in their truck, or they might own a second truck that a driver drives, or they may take time off and somebody drives their truck for them. And what happens is they pay that driver just like they're paid. They pay him as an independent contractor. So if I own a truck and I hire my cousin and say, hey, go drive for me next month, I need to take the month off. And, I say, I'll give you a half of the revenue of the truck. And I just give them a 1099 at the end of the year for a contractor. The problem is the IRS and a lot of states are really buckling down on that independent contractor versus employee relationship. And in fact, we had a client just last month that drives in Texas, and he called us and said he was being audited by the state Texas Department of Labor, not the Department of Revenue or anything else. And what happened is they came in and looked at his business, and he had a driver, he drove during the day, the other driver drove during the night. And they said that that guy should be an employee of yours. He's not an independent contractor. And they are holding that driver accountable, not only for the taxes that should have been withheld and paid, which is thousands of dollars, but also for workman's compensation. So, it's a risky proposition. We can talk you through it here at ATBS. Our business consultants understand it. And, I'm not telling you you're doing it wrong. I tell you that the majority of drivers pay someone else that drives for them as a 1099, but you might need to think about them being an employee in the future and the proper way to handle that. It's something we do here at ATBS. We have a payroll service that we can handle employee payroll and those kinds of things. But yeah, I'm trying to keep you ahead of what's going on in the world to keep you out of trouble. So the slide we're looking at kind of goes back to something I said in the very beginning, and really it boils down to being organized. If you understand the tax dates, I set them pretty quick. You may not have had time to write them down. We have a ton of resources on our website, which is atbsshow.com. There's a link here at the bottom of this page that you can go to, and we publish a tax calendar in December of every year that lists the exact tax dates of when things are due. Your federal highway use tax, your estimated tax, and there's a lot of other useful stuff on there. It's completely free, so feel free to go to our website and you can download that. So next we're going to talk about a few common deductions that relate to your business. And most of these are, real simple and real common sense. If you've got a truck, you can deduct your payment if it's leased, or you can deduct your depreciation and interest, fuel and maintenance, insurance. So, I'm not going to read through the things on here that are simple. Those things. One thing that we do at ATBS is we've got a list of deductions. There's maybe 100 things on there and maybe some stuff that you didn't think about. In the end, what you really need to think about is any expense that I incur in running my business, operating my truck, is probably deductible. At ATBS, we don't want you to be a tax expert. We don't want you to know the IRS code. What we say is if you got a question, send us your receipt and let us check it out. If it's not deductible, we'll let you know. If it is, we'll deduct it on your tax return. So again, if you go to the link at the bottom, you can download that list of deductions. Just a few things that are on there that maybe some folks wouldn't have thought about. Accounting and tax fees are for sure deductible. The fee that you would pay to ATBS or any tax company is deductible in your business. If you have a business credit card, let's say you've got a Costco card and it costs you $75 a year so that you can get some bulk buying discounts. If you're buying things for your truck, you can use that as a deductible expense. You can deduct that Costco card fee. If you have satellite radio in your truck, you can deduct that. You can listen to the weather channel. You can listen to the truck channel. In fact, Andy and myself were on the Dave Nemo show 2 or 3 weeks ago talking about truck driver taxes. That's something that relates to your business. So that subscription to satellite radio is deductible. The things that you have to do for drug testing and health screening to keep your CDL, those things are deductible. So there's a lot of different things that you may not think about. So I urge you to go to the link at the bottom of there and download it and just take a look at it. So next I'm going to talk about some misunderstood tax deductions, and we hear these all the time. They're a topic of conversation at truck shows and classes that we do, and I just want to kind of highlight these things for you. Um, Probably the most important thing that you need to think about when it comes to deductible expenses that relate to your truck is it necessary and ordinary? So when an IRS agent, just picture them knocking on your door and saying, we're going to audit your return, think about, is everything on my tax return necessary and ordinary? So as we go through these, think about that. First thing is a home office deduction. This has kind of been a lightning rod for many years. People want to deduct it. They think it's a legitimate deduction, and it truly is a legitimate deduction. But the IRS has also caught on because people were abusing it. And so they've gotten really specific, and they've got a couple things that they ask. And if you don't meet those, then you can't take a home office deduction. The first one, in my opinion, disqualifies most truck drivers from taking a home office deduction. First question they ask is this your principal place of business? So if I'm a truck driver and I drive 300 days a year on the road and I'm only home, 60 some days, is my home my principal place of business? Probably not. My truck probably is. So that disqualifies you right there from taking a home office deduction. Second thing is they require exclusive use of whatever portion of your home you deduct for a home office deduction. So just because you got a computer sitting in your family room with a big screen TV and a refrigerator and everything else, that doesn't mean you can deduct your family room as a home office deduction. It has to be a single room that is used nothing for business. So, don't be mad at me for saying these things. This is just what the IRS has boiled it down to. So when is a home office a legitimate deduction? I'm sure there's plenty of folks on the call who have a wife that are true independent drivers that have their own authority, and maybe your wife's at home, helping you book loads and figure out where the next load's coming from, and maybe she's helping you with fuel routing, and she's got a computer and she's doing that. So set her up in a room that is used just for business, and you truly can take a home office deduction. Something that's important to understand is at the end of the day, that deduction might save you $200, maybe even $500 in taxes. So it's significant, but it's also a huge audit flag. If you don't do it right, it's going to cause you to get audited, and it may cause the IRS to find areas in other places of your return that aren't right. So it's going to cost you maybe 3 or 4 times what that one deduction cost you. Out of route miles is a huge topic of conversation. We see returns here all the time that get done wrong. I've heard people on the truck channel on radio talk about out of route miles, and there's some really horrible advice that gets given. So I just want to straighten it up and make it clear for you. And to do that, let me just give you an example. From Denver to Dallas, I like using round numbers because they're easy for me to think of in my mind. So let's say it's 900 miles. I'm going to drive from Denver to Dallas. And what typically happens, as you guys know, is I get paid the shortest route miles. I don't get paid the miles I drive. So what's going to happen is I'm going to get paid the shortest route, which is, not probably the best truck highway miles. It's the shortest route, some 2-lane highway miles. So let's say I'm going to get paid 800 miles. Sometimes you'll take that shortest route because that's what's going to get paid. But let's just say it's a day like tomorrow and it's going to snow overnight. So I want to take the safe route. So I wind up driving the long way and I take the 900-mile route, but I only get paid on 800 miles. In most drivers' mind, they think, I just got ripped off. I didn't get paid 100 miles that I drove extra. I should be able to deduct that. What is actually happening is when you drove that 900 miles, you're deducting the fuel that you spent to drive that 900 miles. You're deducting the miles, the tire wear, the maintenance, your truck, you're depreciating it a little bit. So you're actually taking the extra expenses for driving that extra 100 miles on your tax return through your expenses. If you went and deducted that 100 miles on top of that, it'd really be double deducting. And I can tell you the IRS doesn't look fondly on double deducting, and it's going to get you in trouble. So anybody that tells you you can deduct out of route miles is crazy, and they're screwing up your return and they're going to get you in trouble. I just want you to remember that. So the guard dog deduction, it's been a topic of conversation for a long time, and we've taken a couple different positions on it. But as I said, we meet with the IRS, we talk to them, we've consulted with the IRS, and we've actually gotten advice. And a guard dog is a legitimate deduction. Just remember what I said at the beginning. it must be necessary and ordinary. So if you think about that, there's plenty of drivers that have dogs in their truck. When you go into the truck stop to get a meal and your dog's in the truck, I believe it truly is a deterrent that might keep your truck from being thieved by somebody and broken into. So the guard dog we believe is a legitimate deduction, and I don't care if it's a Chihuahua or I don't care if it's a Doberman Pinscher. If it's a dog that barks and protects your truck, that's great. So when you think about that, if I spend a couple $100 a year, feeding my dog and taking care of him and having him in my truck, true, legitimate, ordinary, and necessary deduction. On the flip side, let's say my dog gets sick and I go to the vet and I wind up spending $6,000 to save my dog's life and do a bunch of work. Is that an ordinary and necessary deduction? Do you think the IRS will look at that compared to all the other truck drivers that have guard dogs in their truck and say that's ordinary and necessary? Probably not. That's probably going to get you in some trouble. So, again, just really some common sense. Personal vehicle miles. This is something that goes back probably to the main point I've said, and that's be organized. So many drivers miss this deduction, and it can amount to hundreds, if not thousands, of dollars a year. So every time you use your personal vehicle, not your truck, but your personal vehicle, when you're at home to do something that relates to your business, let's say you got to go to Walmart and get some supplies for your truck, or you got to go to the bank to set up a business checking account. Anything that you need to do, if I got to go to the post office to mail my receipts to ATBS, anything that you do, you can deduct 56 cents a mile every mile that you drive in your personal vehicle. The key to that is you got to be organized. You've got to have a piece of paper and a log, and you've got to track where you went, how many miles you drove, and what the purpose was. Really not that difficult. Keep it in your glove box. Because if you think about that, if I drive, 3,000 miles a year at 56 cents, that's almost a $1,500 tax deduction. That might save me $500 in taxes. So, why do something risky like a home office when I can do something simple like track my personal vehicle miles? It's a legitimate deduction. Medical expenses, I'm going to really touch on two things. There's two different ways to look at your medical bills. The IRS changed the rules a couple of years ago, which is fantastic. Independent contractors used to not be able to deduct all of their medical premiums. So when I talk about two different things, the first thing is the premium that you pay for your healthcare expenses if you pay for healthcare. It can be inexpensive for someone with a family. They can pay $1,000 under the new, Affordable Care Act, Obamacare rules. You're going to be required to have healthcare expense in the future. So as you pay that, that's deductible as an expense of your business. On the flip side of that, you have medical expenses outside of those premiums. You pay prescription drugs, you pay copays, and those kinds of things. Unfortunately, it's deductible, but it's only deductible if it exceeds 10% of your income. So let's say you're an average owner operator and you make $50,000. 10% of that is 5,000. So I can't deduct any of those medical expenses until they get over $5,000. So a little bit confusing, but main thing is I can deduct my medical premium for my health care, and that's important. The next one we're going to talk about is per diem. And I can tell you this is probably, we had someone that already asked the per diem question before the webinar even started. So I can tell you it's probably the most confusing, misunderstood, but one of the most valuable deductions there is. So we're going to talk about per diem a little bit. And before we do that, I think Heather has another poll question we want to pull up. And we just kind of wanted to find out if you guys know and understand what your per diem is and if you've tracked it. So we want to know if you tracked for last year what your per diem days were. So we'll give you again about 30 seconds to answer the question, and we'll let you know how many folks know their per diem days and how many don't. All right, so it's been about 30 seconds. Just about everybody's participated in the poll. So the answer is really similar to last time. 55% of the folks on the call know their per diem days for last year, and 45% don't know their per diem days for last year. So let me just kind of talk you through why that is so important. And for those of you that don't know, why you should really pay attention and hopefully know that for next year. Per diem is a complicated deduction. Let me maybe just explain historically a little bit of the background of it. Um, Anybody that's away from home doesn't have the luxury or the ability to eat their meals at home where it should be cheapest and going to the grocery store and buying their own food. When I'm away from home and I travel, I've got to eat out at restaurants and it costs me a lot more money. So what happened maybe 20 years ago during the first George Bush's presidency, they said that we've got all these business people that are abusing this deduction. They're going out and they're having their 3 martini lunches and they're spending a ton of money entertaining themselves, playing golf and doing all these things. So to level the playing field, we're going to cut that deduction to 50%. So myself, if I travel as a business person and I take, someone that works at a fleet that you might be leased to out to dinner and it costs $100, I can only deduct $50 of that dinner. That's what happened, 20 years ago. And the result of that was they didn't take into account the truck driver who's not having 3 martini lunches and playing golf typically. And they cut the truck driver deduction to 50%. As an industry, we lobbied and said this is unfair for truck drivers because they truly are away from home and they need to, pay their expenses. And so over a period of time in the last 10 years, they raised that per diem deduction rate back up to 80%. We couldn't get them to 100%, but at least we got them to 80%. And so that's kind of the basis and the background. So the way it stands today is it's really simple. For your meals on the road away from home, you don't need to keep track of every receipt and add them up and the pain and agony of all that. You can deduct $59 a day every single day you're away from home. On your tax return, only 80% of that is deductible. So let me just give you an example of that. If I'm away from home for 300 days and I use that formula, that's about a $14,000 tax deduction. That's really significant. It's probably your third or fourth highest deduction next to your truck payments and your fuel. It's a really good deduction. So it's important to keep track of it. The reason it is because if the IRS audits you, they need to see a factual record that you were away from home. So one thing that makes it a little bit more complicated is there's a partial per diem. If I leave today, let's just say right now, you finish listening to this webinar, you leave your home and you go out on a route, you got to have breakfast and lunch at home. So legitimately, you shouldn't get a per diem deduction, but you're going to have to eat dinner away from home. You're going to spend the night out. So the IRS tells you that you need to take a partial day per diem for that day that you leave and that day that you get home. So, it's complicated in the fact that you get 75% of 80% of $59 a day. That's a rough formula. So in the end, all we ask our clients to keep track of is their partial and their full day per diem, and we'll do the rest for them. At the bottom, again, there's a link on owner operator tools at ATBS. We've got a simple calendar that you can keep track in there. There's really two ways to do this. A lot of companies have gone to electronic logs, and so you don't even have to keep track of when you're away from home. It's done automatically for you. The problem is if you're not keeping record, companies delete that because it's your logbook and they keep it only as long as they have to, which I think is 90 days. So if you don't get your records on a regular basis, you're not going to be able to know from your company how long you were away from home, how many nights for the year. So we really recommend kind of a manual way of doing it. Download the sheet at the bottom of the page and just keep track of it every day. It's really simple. At the end of the year, keep track of it. Just if you think about it, if I miss 20 days of per diem because I didn't track it right, I might be missing $1,000 deduction. So it goes back to what I said in the beginning: being organized, saving money on taxes. It's our responsibility as your tax preparer, but it's even more your responsibility to make sure you get us the right information so that we can do the best job for you. So I said in the beginning, there's really two different things: tax deductions and tax credits. And let me just help you understand that in a little bit more detail. If it's a deduction, what it really means is it's offsetting my income. And so if I make $100 and I spend $50, I have $50 left that I'm paying tax on. When I have a tax credit, it's a one-for-one offset on my tax liability. So what that means is at the end of the day, if I figured my tax bill and I owe $5,000 in taxes, if I get a $2,500 credit, it reduces dollar for dollar my tax bill. So I go from owing $5,000 to $2,500. So it's significant. And there's three, credits on here. And again, like I said in the beginning, I don't want you to be a tax expert. All I want you to be is smart enough to ask the right questions of your tax preparer, whether it's us or someone else, and bring these things up. If you have a child in college or more than one child in college, it's a great deduction. You can deduct up to $2,500 for the tuition that they pay to go to college or that you help them pay to go to college. The second one on here, earned income tax credit. It's a bit of a lightning rod, like some of the things. It will almost certainly, in a lot of cases, cause audits. If there's tax preparers that are doing a lot of earned income tax credit returns, the IRS will come and look at them as a tax preparer and find out why, because a lot of people scam the system and they use this to get money back. So, in the beginning, I said the federal income tax rate is 0 to 39.6%. It's actually below zero because there are people in America that don't pay any taxes that actually get money back from the government, if you can believe that. The way that it's set up is really to support those less fortunate people that don't have enough money to eat or pay for shelter, clothing, those kinds of things. And so the earned income tax credit is part of that. Just an example is in the last month, our tax department told me we did a return for a guy who had a tough year last year. He got sick, he was out of the truck, he didn't make a lot of money. We did the return and we sent it to him, and he was going to get $800 back on his federal tax return. And the guy was astounded, and he said, "How can I be getting money back? I didn't pay my estimated taxes. I wasn't an employee. I didn't have any money withheld. So the government didn't get any money from me. How can I be getting money back from the IRS?" It was because of the earned income tax credit. It's not for everybody. Most owner operators make way more money than you would ever get back in the earned income tax credit, but it does help those that are people that are lower earners, or if you had a rough situation last year. Child care and dependent care tax credit. If you're married and both you and your spouse work, and you've got to pay for your children to be taken care of, there's some good deductions that again are credits that can help you offset your tax bill. So, consider those things when you look at your taxes. So, kind of to the organizational piece, one more time, I'm going to say it's critical that you're organized. If you're not, let me just, give you the simple example. You're walking out, the truck stop, and you just spent $100 on something that's for your truck. And, you put it on when you get to your truck, and you take the receipt and you lay it on your seat because you think I'll deal with it later. I'll send it to ATBS, or I'll add it into my expenses at the end of the month. And, next thing you know, you open the door and that receipt, a wind comes up and it blows it out the door. That $100 that just blew out the door lost you $20 in tax deductions. So being organized and tracking everything is critical. Tracking your revenue. Um, Let me just tell you how it works from the government perspective. If you drive for a company that you're leased to, or even if you drive for multiple companies under your own authority, you're typically going to get issued what's called a 1099. What that is a description, a form that the company sends to the IRS that tells them exactly how much money that they paid you through the year. So most owner operators, you'll do anywhere from $140,000 to $200,000 in revenue per year. The government will get a form that says that you generated that amount of revenue every year. So let's start with that. The next thing is record and calculate your expenses. The goal is to offset as much of that revenue with expenses as we can, because the end of that is what makes up your taxable income. And so let me just tell you for a minute how people get in tax trouble that don't pay attention and do these things or don't file tax returns. The government knows you made, let's say, $150,000 last year because they got your 1099. Let's say you got busy and you couldn't file your tax return, and you just went on for a couple of years without doing that. The IRS sooner or later is going to say, we didn't get a tax return on this guy, but it says that he made $150,000 in revenue. They're going to do something called file a return for you that's called a substitute for return. And they're going to figure out through a pro forma, do a return for you that says you made $150,000 a year. You're going to look like a high income earner because they don't have any expenses to offset against that because you didn't send them any. And they're going to send you a tax bill for $50,000 or $75,000. And when you hear a lot of these tax resolution cases that got negotiated down from $300,000 to $5,000, that's part of it. It's not legitimate that you truly owed that $75,000, but as far as the IRS knows, you did. So part of it is being organized and getting those expenses together. So, in the end, you take your revenue and you minus your expenses and you find out what your profit was. And you take all the deductions, the per diem deduction, and the bottom line is we come up with your adjusted gross income, and that's what your tax to the federal government and state government are based on. Something that's important is that what the statute of limitations are. Just because you filed your tax return, half of you have already filed your tax return for last year. That doesn't mean you're done. The IRS can audit you and they can come and look at your stuff for up to 3 years, which is in their law, but there's also ways that they can go back further than that. And sometimes they do. So what we recommend is that you keep everything together for at least 5 to 6 years. If you're an ATBS customer, we make it really simple for you. When we're done at the end of the year with your tax return, we send you a disc and it will have all your receipts, all your revenue, and your tax returns on there. You keep it on a shelf, and if you're ever audited, I guarantee when the IRS sees a person organized like that that has everything together, the audit goes much simpler. We have a really good track record with audits with the IRS. One thing I want to just talk a little bit about, and I think it's critical to understand because I hear all the time, if we lose a customer, and they go to another tax preparer, we'll call them and ask them why they left us. And a lot of times we hear, this tax preparer tells me that I don't have to pay taxes, and they're going to, help me screw the IRS. They're going to help me take, deductions. In the end, what I really want you to think about is you became an owner operator for a reason, and it's to be your own boss, and it's, to make money on your own. You don't want to be an employee of somebody else. And so by doing that and taking charge of your business, when you do a tax return, the tax law, even though it is law, it's open to interpretation. And I'm sure you've all seen surveys, you know, all kinds of newspapers and magazines do them every year. They take the same tax return and they give it to 20 different tax preparers and they get 20 different answers. That's because it's complex. It's not simple. So, if we told you you owe $5,000, you might go down the street and they might tell you you owe $5,500, or they might tell you you owe $4,500. There's always going to be a little bit of discrepancy. In the end, it should be truthful and as close as you can make it. But the bottom line is you can save up to $20,000 or even more in your business if you manage your business, if you do a budget and you pay attention to your numbers every month and you really manage the business. So the big money isn't in taxes. It's just kind of a byproduct of your business. Concentrate and spend your time, dealing with your business and managing your business. And that's part of what we do every day with our clients. So, we're getting close to wrapping up here, and I want to tell you a couple of things. Keep your business audit proof by making sure you got records of everything and tracking everything, and we can help you do that. Couple of successful tax strategies that I want to help you understand. There's a lot of things you can do as a self-employed person around retirement. We don't have time to go into them all, but as far as setting up retirement accounts and putting money into them, travel expenses, some of you may not think about. Maybe you're going to the Louisville Truck Show that's coming up in about 3 weeks. Whether you're driving your personal vehicle or your truck, that's a deductible expense. You're going to go there and learn about your industry and your job. And, let's just say you tack a couple days on the end of that and your wife goes with you and, you turn it into a little bit of a vacation. The main purpose and the main time was spent going to the Louisville Truck Show to learn about your business, but you can use that semi vacation and write off the expense of that. Something that we find some of our folks doing is employing their children. There's ways you can have your child wash your truck, clean your truck out for you, do some of the jobs that need to be done, and you can pay them some money, and it saves you some money on taxes. And if it's below a certain threshold, they don't have to pay tax on it. So, there's quite a few of those. Again, without getting into a lot of detail, things that you can ask your tax preparer to work on so that you can get them, set up to help you. One of the most important things that we deal with is a proper business structure. And so I want you to think about what's right for you. We see people that come here all the time that have set up a C Corp or an S Corp, and they did it because they heard on the radio it was the right thing to do and it would save their business if they ever got in a crash or, somebody talked them into it. In the end, it's complicated. And I can tell you that 98% of the time, the proper structure for one of our clients that's an independent contractor, sole truck owner, excuse me, is being a sole proprietor. It's just simple. And all you do is add a Schedule C with your business expenses onto your normal tax return so it doesn't cost you a bunch of money. If you got to do a corporate return, it's going to cost you at least $500 more. So the right structure for most folks is a sole proprietor. But I can also tell you that our industry, as I said earlier, if you have someone driving your truck, many people that are leased onto carriers these days, the carriers are asking those drivers to become incorporated because it helps insulate between are you truly an employee, are you independent contractors. So we see more and more contractors going down that road. In fact, we help many do it. And what we recommend is that you become an LLC. It's a pretty simple process. And in the end, you wind up being the same thing as a sole proprietor from a tax return perspective. On the flip side, if you're making a good amount of money, there's I don't want to call it a tax game, but there's some things that you can do on that self-employment tax, and you might be able to save yourself $3,000 or $4,000 or $5,000 in taxes if you set up yourself as an S corp, as far as paying taxes. So again, without getting too complex on the call, some to discuss with us or your tax preparer to see if it makes sense for you. If you're netting more than $60,000 a year, it's pretty likely we could save you $3,000 or $4,000 a year through that process. So kind of to conclude here and wrap things up so we can answer some of your questions, what I want to say is what I started out with. Paying lower taxes starts with you being organized, asking the right questions, helping your tax preparer understand, your business, your life, and everything going on really will pay off dividends to you in the long run. Most important thing is deal with someone that understands your business, someone that's in trucking, that understands what you deal with every single day, and deal with someone reputable. There are cases today where truck drivers are using, or many people are using, tax preparers that quote unquote screw the IRS. And in the end, what's going to happen is if someone's helping you screw the IRS, the the IRS is going to figure that out before long. Not only do they take you and get you in trouble, but they'll go to that tax preparer's office and they'll find out the thousands of people that they've done tax returns for, and they'll go audit every one of those people. And it can result in a lot of penalties and those kinds of things. So, the last slide here that I'll touch on, last couple of slides, is if you're one of the 50% that haven't already filed your tax return, we've got a tax organizer at the link shown on there. You can download it from our website and it'll help you get everything together. It doesn't cost any money. We ask all of our clients that need a return done by April 15th to send us their stuff by March 7th. So if you're on the phone and you're a client and you haven't sent your stuff, you have until tomorrow. That's probably not going to happen. So um, what that means is we'll likely file an extension for you and we'll wind up filing after April 15th. And let me just help you understand a little bit about that. The penalties associated with not filing and not paying. If I don't file and I don't pay my taxes by April 15th, the IRS is going to assess me a penalty of 5% per month to a maximum of 25%. So think about that. Again, in simple numbers, let's say that I owe $1,000 in taxes and I don't file within a 5-month period, I'm going to owe another $250. Most people owe a lot more than $1,000. So that adds up really quick. Let's say I don't have the money and I can't file, at least file an extension. By doing that, you go to the second category and it's not nearly so painful. It's 0.5% per month. So on an annualized basis, it's about 6%. So if I owe that same $1,000 and I don't get my taxes filed and paid until August, it's going to wind up costing me a $30 or $40 penalty. It's a lot less than that $250 penalty. So key is get filed, file an extension, and take care of it. So the last slide gives you our phone number, website. If came to us through the Team Run Smart website and you're a Team Run Smart member, you can get a discount on our services. So with that, I'm going to wrap things up. Andy Irwin is here with me, and we're going to take a look at the questions and kind of go through and answer any questions that you might have. One dealt with per diem, and we already answered the per diem question. Somebody asked about where they can get the per diem tool online. You can go to our website, simply type in, per diem or tax per diem in the search box, and a lot of those things you can, it'll take you right to where that form is. We have a question that says, how can you pay $7 for every dollar that you earn? And I don't quite understand the question, but maybe it goes back to, I said, if you're a high income earner, between state, federal, and all the other taxes, you might pay $70 out of every $100 that you earn. So, tax law is complex. You might pay zero, you might pay 50%. It all boils down to putting everything together and, figuring out how much you owe. We have a question on how do I get a copy of the video. Heather, you want to answer that for him?
Yep, a copy of the video will be available on atbsshow.com and it will be available on teamrunsmart.com. And also, you will get a follow up email at the end of the week that will give you the link to those videos. So that will look for that in your inbox. It'll be at the end of the week.
We have a question about a rider or a secretary. So my guess is that relates to the per diem of somebody that's riding in your truck with you, and I'll let Andy answer that one.
Good question there. That comes up quite a bit, and it can go a couple of different ways there. If you've got a rider with you that is not a CDL driver, the one thing that you need to make sure is that they are an absolute part of your business, meaning they're either navigating or helping load or unload or helping with tracking of documents, things like that. Make sure that you can make them a bona fide part of your business. Now, then they will they will be able to get their per diem as well. Now, they don't get the 80% of the deduction like those that are subject to Department of Transportation rules. They would get the normal 50%, but they would still get the per diem as long as they're a bona fide part of the business. Now, get their CDL, drive occasionally, they get that per diem, and they would also get the 80%.
Thanks, Andy. Next question is, does the child have to live with you in order to get the credit? I am not sure if that relates to the education credit or the home care credit. I'm guessing maybe the child care credit.
Yeah, for definitely for the child care credit, you need to be able to provide support. Maybe looking at earned income credit as well. And the general rule for most of the credits that apply to children is that they need to live with you at least more than half of the year, and you probably need to provide more than half of their support too. So, definitely you want to look into those things. The earned income credit is one that can be pretty valuable to you, but um, will will require that you have all the right documentation to take that deduction or that credit, excuse me.
Where do you find the per diem tracker? The link didn't seem to work. We'll make sure when we send out the PowerPoint recording to you that we've got a proper link. And again, I'd say go to our website and just put per diem um,
In
in
the
the
search
search
field.
box,
Yeah.
and you'll find it. We have something in here that just says Social Security. Unfortunately, I'm not quite sure what that question is, so we'll skip that one. My dad just started. He has expense from 2012, but he didn't make any income for that year. But in 2013, can he add those expenses to his 2013 taxes? So I think they're saying, can they deduct 2012 expenses in their 2013 taxes because they have income in their 2013?
And the best way to do that is to take the expense in the year. You're supposed to take the expense in the year that it was incurred. So even though um, he may not have had any income in 2012, if he was setting up his business and starting the business, then those expenses would be deductible in 2012. So I've seen other preparers and things that'll lump those into to the next year. The best and most accurate way is to actually take them in the year incurred.
Can a business account bank statement be used as proof or replace receipts for tax purposes? So I think the question is, do I need a real receipt if I went to Walmart, or can I just use my bank receipt that said I had a Walmart expense?
So ideally, again, you want the receipt to show what you purchased. In the case of an audit or an exam from the IRS, they will accept bank statements in cases where they can tell exactly what happened. So keep your receipts as much as possible. Bank statements are good backup for some deductions.
Can you take all these deductions if you are leasing the truck you use and the company treats you as self-employed, but you would never own the truck?
Absolutely. If you're treated as an independent contractor, which a lot of drivers are that are leasing the truck, you're still self-employed, and every expense that you have as a self-employed person is still a business deduction for you.
All right, I think that's all the questions, and boy, we sure appreciate them. Those were some great questions, and we appreciate everybody that attended. And as Heather said, we'll get you a copy of this out if you missed some stuff and you want to hear more. One other thing I'll tell you is if you've got Sirius Satellite Radio, Andy and I are going to be on the Dave Nemo show again on March 18th, which is just a couple weeks away in the morning. So you might check out that show, and we'll be doing a similar thing, taking questions and answering. And it's always amazing. People come up with some really fantastic questions that haven't been asked before. So thanks for attending today, and hopefully we answered your questions. And if we can help you out, just give us a call.
All right. Thank you. Bye bye.